Welcome back to another segment of the very brief series where I discuss my largest holdings. In today's video, Verde AgriTech. So as is pretty obvious for a video with this title, I do own shares in this company and it is a relevant position for me, but that is not to say that it makes sense for everyone. So remember, this is my take, not investment advice. So I want to start with an investment overview. So I want to start this video with a question that I will discuss throughout the video and give a fair bit of give and take on different perspectives and try and explain what I think about the company, the price, the prospects, and stuff like that. But the question is this a growth stock or a value stock? And why? Well, why not both? So Verde has made a number of significant advancements over the past year. Now, to start with, the volume growth looks like it should exceed 50% year over year, and that's pretty good. I really mainly focus on volume growth because I believe that that is the best indicator longer term. So that is one significant aspect. Another thing is the capital sunk towards the new plant, which will triple the capacity. So that isn't totally paid for, but the progress is being made and they're working towards getting that plant up and running. Should be ready in less than a year at this point, 7 months approximately. Plus or minus. And this is relevant because they have hit their capacity constraints. And in the third quarter of this year, they hit their capacity constraint. And into the fourth, they have now informed shareholders that they were sold out up until mid-November. And presumably, if they had more capacity, hopefully in the future, can sell more. And the last significant advancement that has continuously de-risked the investment is they have continued to gain both scale and credibility. Credibility in terms of there is more adoption, there are more success stories, I guess you can call it, with the product, and there's continued adoption growth, which is really one of the bigger risks here in terms of you could look back at where the company was a few years ago. Will people want to use this product? Will they continue using it? Will they think it works? Will they be able to convince other people to use it? How many people are going to want to use it? We still don't know in the end how many people will want to use it. What we can continuously see is more. And when I say they've gained scale and credibility, well, you look at the marginal cost of production, it's fairly low, but there are costs with running a company and that type of thing. So as you gain scale, as you gain sales, you could first start talking about profit, then talking about, what you can do with that. Can you use it to grow? Can you use it to return to shareholders? But there's an initial amount, there's an initial time where there's no profit, but now there is. So that's moving in that direction and expanding further into that direction is very positive. Which leads me to something that I believe is very important, the profitable growth aspect of this company. I think it's very important that investors see and understand that what the implications are of profitable growth versus potential growth. Profitable growth, seeing near-term profits and understanding what those profits can be used for, help the company show that they don't need to issue more equity, they don't need more capital before they can grow. Obviously, they're going to spend the money to grow, but often you look at the companies that have big potential, big growth potential, and the bear case is, yeah, but they're going to need money to grow. And so in that sense, the market price becomes highly arbitrary because you look at, well, if the bears have their way and the market environment is negative, well, then the price could go to whatever low point you want and they'd still have to issue equity. Otherwise, they're just losing money. But profitable growth means that the company is not reliant on the market and it de-risks the situation. And understanding that about this situation, which hopefully we can now see in the coming quarters better, is that this company is profitable and they're reinvesting those profits in capacity expansion and then perhaps other things or perhaps shareholder returns. And I'll admit that a few months ago, I kind of thought that seeing this would or seeing that this is coming would propel a re-rating. It doesn't seem to have yet, but that's another topic. So the other thing I mentioned is that they have sunk the capital. Well, they've started to at least. So they should be able to pay this off within a year or two, depending on price. Hopefully 1 year if it's at this price. But I think it's a significant milestone because it means they can triple their capacity. And as I said, they hit capacity constraints this year. So maybe they could have achieved more than their pretty decent growth if they had the capacity. But again, you need the money to get the capacity. But anyway, so assuming my long term, which is well reduced from today's spot price, this capacity constraints allows them to take their annual EBITDA up to around $50 to $1 per share, depending on what margin you want to use and stuff like that. And that is significant movement from the capacity we are today, and it takes them to a company that is, all things considered, far more stable than it was a few years ago, or even just last year, this year. So that is something that the money to get there has been spent, and from there, if once that's paid off, going forward, they will need more money for expansion, but it de-risks them for a while. And important to remember that this is a very, very long life asset and there's significant expansion potential from there, and it could continue for a very, very long time at 1.8 million tons per year. It also means that, again, once this is paid off, there is free cash flow that can be spent on or used for something useful, such as an accretive acquisition, share buybacks, dividend, all of which are could be very shareholder friendly and or accelerate growth in more than the area where there's significant organic growth potential. Now, there are two main drivers that make me say what I think is most important to focus on is volume growth. And the first is the volatility that we've seen in the market, the price volatility, big swings. And the second is that when we look at sales growth or sales or revenue or things like that, that I don't think it necessarily means as much as it could, is that there can also be a big swing versus selling CIF versus FOB. Now, CIF stands for cost, insurance, and freight. FOB stands for free on board. That doesn't matter unless you're in the business, I guess, but it does matter when we're looking at the revenue and profit margin and costs, really, of the company, because they could swing wildly while not really having much difference. Let me explain. So while the bottom line isn't different, look at these two numbers and you'll kind of understand. So if they sell at, say, $100 a ton free on board, that would mean $65 in revenue, approximately, with $10 cost, approximately again, but $55 profit at, and look, the margin's very high, 85% margin. That's good. But this price is also decently high. Versus selling $100 a ton CIF, that would be $100 in revenue, $45 in costs, $55 in profit, so same thing there, and a lower margin at 55%, which is still good, but again, we're using a high cost. So the difference being, in CIF, the company has to pay for cost, insurance, and freight, versus in FOB, it is the clients. So that means there's a big swing in costs, or can be, based on really nothing. And similarly, big swing in revenues. So for that reason, if we're transferring from CIF to FOB, FOB to CIF, the costs look like they can swing wildly. The revenues look like they can swing wildly. And in the end, it doesn't matter. And I think this has confused a lot of people, myself included, in the past. And so it's just something important to understand. In this next part, I'm going to discuss some common criticisms that I see of the company and my opinion on that. So much of the criticism I've seen around this company has come from investors who are unhappy or disagree with some of the past management decisions, along with some typical junior miner frustrations, I'll call it. If you've been involved in a company without revenue for too long and you're getting frustrated because the stock isn't going anywhere. And often the blame comes out in management because, again, over time, if you don't have any revenue, your source of capital is shares, and so there is constant debate and frustration in that regard. So while the company is profitable now and has been for a little while, there's some shareholders that have been involved for longer than that, and that has led to some pickiness. And even still, I can see there's a number of shareholders that are very picky in a number of ways, and either talking about, management promising too much or being too pessimistic, or it goes on and on about little issues that they have with the company and things that have happened, or dilution. It's a constant concern of shareholders, and rightfully so. You want to make sure that if you believe the company is cheap, that it doesn't get diluted away. Now, what I found on those topics is that while some will say that management has been closed off, I haven't found that. I've found that they've been receptive to productive discussion and, polite, productive discussion, and they seem to be interested in improving the company and integrating shareholders and making them feel more like they're part of the story. Now, I believe, yes, there have been some missteps in the past, and as those get recognized and management is aware of, what has worked, what hasn't worked, and better ways of leading the company going forward. I think that now that the company has achieved profitability, this kind of walks into the next point of allowing them to grow without dilution and without necessarily overpromising because they need capital. Hopefully that is the case. And on the dilution front, there has been a bit of dilution in the past. That is how the story goes with junior miners. Now, going forward, I expect that to be reduced significantly. And that's part of why I think, it hasn't been so bad. They were in a tougher position than they currently are. So I would expect that even though the dilution hasn't been really that bad in the past in the context of what it could have been, and if you look at other companies that have been around that long and have done different things, I don't think it's been that bad here, but I do think it will reduce further going forward. I think the company has progressed a lot since, if you look at 2006, 2011, 2016, it's a very different company than it was back then. And I think this progression, while there has been some dilution, the dilution hasn't overwhelmed the progress. You know, with the talk of dilution and transitioning to profitable growth, I'm reminded of Constellation Software. Now, most of you probably don't know, but some of you probably do. This is a roll-up, which means a company that acquires other companies, but it's a software company in Canada, and it is beloved by shareholders. Why? Because for the last more than a decade, they've had zero dilution. Their share count has been stable, completely stable. And that's very unique for a company, especially one that buys other companies, because it has shown immense capital discipline, and the shareholders know what percentage of the company they're going to get. So while I'm not saying that Verde is ever going to get there to that degree, relative to where they were before, they should be moving in that direction. Why? Well, before they needed money. They needed money to pay management. They needed to, they properly incentivize, align the management. But at this point, I would think management is mostly properly aligned. They have shares. They want the company to succeed. So relatively less payment in shares, relatively less external capital is needed going forward. Now, could there be another company such as Constellation? There probably will be out there. I'm not saying it will be Verde. I'm saying that compared to years ago, the dilution should be reduced because they can be a profitable grower and not a company strapped for cash. Now look, as Verde grows, hopefully, there's going to be a lot more eyes on it. So there's going to be a lot more criticism and a lot more discussion around price and what's the right price and stuff like that. And so there's going to be increased expectations also as it grows. But I think that some of the common criticism has been, look, the company makes a certain amount of profit and a certain percentage of that goes to management. Now, it's funny because this wouldn't be a problem, or it wouldn't be a point of discussion if the company didn't make any profit. There's junior miners that don't make any profit but pay management, and so it's not like, oh, management makes this percentage of the company's profits. But right now, I think the company is at this awkward transitory stage where the amount of profit, a notable percentage of that is used for paying management. I believe that this is transitory. As I said, it's a popular word these days, probably overused at this point. But as the profit grows, I believe it will drastically outpace the percentage of the profits that go to management. Which leads me to my next point, which is every single time I discuss this company, one aspect of pushback that I get is management compensation. To which I will say it's not low, but this is a larger job than most juniors out there. This is not raise money and poke a few holes in the ground. This is develop a market, adding products, running a mine, and growing sales in this environment where there is no spot market that you're selling into. So it's not the simplest of jobs, which in theory would qualify for higher compensation. Now, again, it's a relevant pay for a company of this size, which is an issue that I expect over the years will drastically be diminished. Now, I could discuss this issue in nuance at much more length, but suffice it to say, I think the story or the negativity in this case is overblown, especially if the company continues its growth at more than 50% compounded. Now, suffice it to say, at this point in time, and given the current realities, in my opinion, the current CEO and management is the right one that we'd want for the job. There are things that could happen over time that would make me change this view. If there's overly declining growth, if there's unreasonable growth in compensation, significant capital allocation mistakes, or things like that. But at this point, if you're looking for my opinion on the subject, yeah, it hasn't been perfect, but I think that going forward, this is still the team that's best suited for the job. Now, when it comes to the product, some of the pushback I see is that some people think that because it's a powder, that will delay the adoption. And it may, but again, the powder, it's a powder because that's a feature, not a bug. The product is absorbed based on surface area. And so if there's more surface area because it's more fine, that helps the absorption. Similar issues with the fact that it is diffuse. And again, yes, it does take more volume of product for the same amount of field. But again, this is a feature because part of the problem with the alternative, part of the problem with potassium chloride is that it is over concentrated. So here it is more diffuse, but there is other nutrients in it. Now in this next segment, I will be discussing the product, the market, and the impact that the company can have. Now, just to discuss the product a little bit, many people will talk about how potash or potassium chloride is not an ideal way to provide the nutrients. It is bad, it's unhealthy and damaging to the plants, but it is kind of the way that we kind of walked into it because it is having a very dense concentration of nutrients. Now, arguably, that's part of the problem, but we know it's a problem, but we use it anyway. Why? Well, because there's not really a good alternative in most places. Now, Verde's product is trying to be a new but old solution. And the way Verde is trying to sell this is in a provide more for the same price value proposition. And I'll get more into why the solution and having this product like this affects the investment case in just a little bit. So if we are talking about more for the same, providing more value for the same price, for pricing, we need to look at the potash market. It is a fertilizer, and fertilizers are in high demand right now because, well, their pricing is high because food pricing is high, and so on and so forth. Now, for Verde's case, I don't consider high pricing to be a significant threat because one, again, growth. Two, I don't think this price is really being priced in at all. All the metrics that I use, that I look at, ignore the current high pricing and kind of use a long-term pricing. But if we look at how the market stands, the market looks tight. You can tell that by look at a price chart. It is not a overflowed market like many were arguing a few years ago. And so while capacity is coming back, the utilization rate is getting up there. It is pretty high. And, prices need to support capacity additions. And if we look back at where they were a few years ago, they were not supporting capacity additions. Why? Well, market narrative was there's too much. So what happens? Eventually, there's not enough. So prices need to support that, which means I don't think them going back to where they were a few years ago is supported. Obviously, they're high right now, so we need to kind of figure out what a middle ground is. But we now looking at, well, what price do we need to support capacity additions? The big clue here that I look at is look at what BHP is doing. Everyone talked about how Jansen is going to crush the market when it arrives. Well, one, it arrives in 2027. Two, it's really not as big as it was originally planned. Three, it is really expensive. Meaning, if Jansen crushes the market, BHP earns no returns. So it's a high cost addition many years out. I don't really think it's going to be that big of a problem. It's more of a story than a reality. But I keep harping on this in terms of I don't mean to put too much pressure, but look how much they're spending for that capacity. It is expensive to add capacity. Now, just a quick note, I want to say that if this bull case is right in terms of the price needs to be somewhere that it will incentivize new production, that is not what I'm incorporating into numbers that I use later for pricing. I am using a blended number that includes prices we saw over the past few years and a bit of more for potential upside. But I'm not using that as a base case, although there are a number of market participants that would. Another worry, or at least topic of discussion that I've seen a bit recently, is worry about a take under, so a buyout at a price that doesn't reflect the value. Now, I've seen some people that are concerned about this. Personally, I don't think it's a big concern. To my knowledge, there's no such situation in any way close, but again, I wouldn't know this type of thing. I would find out when everyone else finds out. Two, if that situation were to arise, it would mean that it would need shareholder support. And so it would say, while I cross that bridge, if we come to it situation, I wouldn't be interested in selling at any price near where we are now. And hopefully many shareholders would agree with that assessment. But again, support from the shareholders would be needed. And I would think that for most people, I know for me, that would be price dependent and I would need to be paid for some of the potential value. Now, a few other comments on this theoretical situation is takeouts happen at premiums. So if whatever the prevailing share price is, presumably if there were such an event, it would need to be at a higher to significantly higher level. So I don't think this is really a short-term concern, at least, but who knows. The other thing I would say is that this is interesting from a ESG or impact investment standpoint, in that I think that there is significant unpriced positive impact value in this story. So if there were a takeout, I think part of what value this could bring to another company would be the positive impact that it has. Again, this is a healthier way of growing food. And so that type of story is the type of thing that could reduce cost of capital to a bigger entity that would have such a thing in their portfolio. Meaning that I would hope that the shareholders would think of this and think of the value that it could have to a potential acquirer in the deal and get paid for some of that value. Now, again, nothing leads me to think that this is something that would happen near term or anything like that. Now, transitioning into the next segment, I want to first discuss the net present value and the new pre-feasibility study. So I don't think that the old net present value is too relevant, so I don't really use that when I'm trying to figure out what it's worth. This is because I don't think it properly incorporates the difficulty of finding sales and growing sales. In that respect, I think the sales numbers that were set in the old one were overly aggressive, and I think that the fact that those sales numbers were unmet is one of the factors that frustrates people. They're doing what they can. They're growing what they can, but still hasn't met where they were supposed to be, and that has been a source of frustration. So the company will grow as expeditiously as they can. Numbers on a study won't really change that. So while having more and new numbers and new details, costs and such will be nice, and hopefully we'll get new insight into different margins of different products like backs and that, I hope that the new one doesn't have similar issues in that, it sets a more realistic growth target. Now, the old one had a very large eventual target, and maybe the new one will go even higher. But I think that getting there is more of a question, and setting expectations too high wouldn't necessarily help. But again, the company will do what they can. It will grow what they can. So just know what parts of the new PFS will be useful and what parts will be hopes. Now I want to discuss a little bit about what it's worth. So let me start by looking at today and let absolutely everyone down and discuss what assumptions I think are reasonable to look at in terms of long-term targets. So to start, here's what I kind of look at. I think a terminal multiple 8 times EBITDA, and I'm assuming that long-term margin, and this is an absolute complete guess, but $25 Canadian per ton. So if I were to look at what it's worth, I would look at, let's call it next 12 months volume times 25 divided by 53 million times 8. Now, I'm pretty sure I have done this in a grade 4 math test, if I remember, and because it's really not the most difficult calculation. You look at tonnage, margin, per share, and multiple, and that's really all that you need to do to have a very rough basic idea. Now, of course, there are plenty of complicating factors. For example, most sectors with this kind of growth front run a few years, and I'll talk about that in a second. Second, capital. Since capex is near-term spent, that means that there can be capital returns. For example, a buyback that would drastically change this number, or dividends along the way or whatever. But buybacks, for example, particularly would juice the math. Next, the prices can be materially above or below that number. So, for example, let's say that in 1 year the margin is closer to triple that. Well, if you take that, then add to my point about buybacks, you can see how you can get some very different numbers just by having a few good years along the way. That said, doing that very quick, very rough math would give you a $1.80 price target. However, that's not what I believe reflects the value proposition here. Because if we remember a few months ago, the price was above that. And so then why didn't I sell? Well, maybe I'm dumb, but maybe I believe there's more to the story than that. Because with a stock, there's always 3 questions, and the price is a single answer to those 3 questions. The first, what is it worth? The second, what could it be worth? And the third is what should the price be now that fairly reflects all of these questions? Because now I need to discuss back to the title of this video. These are my largest holdings. So why is this a substantial holding if the price target is, just a few percent above where it is now? And that's because it isn't. It's higher. Because let's look, as I said before, a few years out. because I don't own this for today. I own it because I hope they can hit their targets in a few years. So let's do the same math. Let's say they can get to 5 million tons per year, which I don't think is overly optimistic when we look at the pace of growth and we look at the size of the market. So if they can hit 5 million tons per year, which is 1/5 of what their current feasibility study says the mine can get to, well, then the math says about $18.50 a share. If they can hit to 10 million tons per year, which I don't think is off the table, and management seems to think they can get beyond that, well, that would be closer to $37 a share. And remember, the current PFS says that the mine can theoretically go up to 25 million tons per year. If it gets there, if the growth gets there at some point. Growth has been extremely rapid recently, but it could decrease in future years, so we don't know. That's why things have to be discounted, and we don't look at what it would be worth at that point now. So the question is, where between here and the pie in the sky is the company worth? And this is where the discussion comes in, because the bulls would say, well, why only 8 times EBITDA for a company with this much growth? And you're right, if the growth continues, it's a ridiculously low number. And also, if we're talking about a quality company that deals with, sustainability of food, I think that multiple is too low. But the debaters would mention, look, it's something, they use commodity pricing. So whether you think of it as a commodity company or not, it still uses commodity pricing, so that in theory limits it. We don't know what the growth rate was. It was very quick, but if we looked at recent guidance, we don't know if it's declining. So, there's a discussion there. And there's also temporary constraints, such as permitting, such as, if that gets passed, the value increases. But for now, it's a discussion, and like I said, if the growth rate is much quicker than, if it's a very fast growth rate, then we need a higher multiple. But for now, we don't know. And in terms of getting there, the reason why I start with what would it be worth today is because you need to crawl before you can walk. You need to show there's profitability. You need to be able to grow at a fast pace when you're at 500,000 tons per year if you're going to continue growth beyond 1,000,000 tons per year. But if we wanted to come up with a more realistic, a more fair price target, considering how the market normally does this type of thing, we would need to come in with an unhappy medium. And by that, I mean, okay, the market normally guesses at growth rate and looks forward 2 to 3 years. So let's say we look forward 2 years at 50% growth, which is kind of closer to what was targeted this year, although in fairness, with running into capacity constraints, then we would come up with a number 340. If we wanted to look forward 3 years with a 70% growth rate, then the number would be close to 750. So point being, a lot of numbers can make sense, but if we wanted to have something for the bulls to look at and something for the bears to look at, we would probably pick a number somewhere in the middle of there, $5, and say, okay, that's probably a realistic fair price, where if the bulls are right, they make money, if the bears are right, they make money, and kind of a realistic starting point for discussion. And in case you were worried that there weren't enough numbers to talk about, remember, all of these are basically assuming a margin that should be well below what they are receiving at these prices. The company could easily, if we assume sustained higher prices, even higher but below where they are now, they could easily earn and pay out or buy back multiple dollars per share before prices return to the margin I assumed. We also don't know and could debate, is 8 times EBITDA the right number? Should it be 4? Should it be 6? Should it be 10? 12? I don't. So that is another point. Another point of debate is, well, what if they, come up with another technology or change how the pricing works, or, there's an acquisition. So point being, it's messy. This is very base case, very back of the envelope type of thing. But in markets, there are so many possible scenarios that coming up with one that makes sense is a bit of a noisy proposition. But again, always in markets, pricing is everything, both when it comes to investors making decisions and management making capital allocation decisions. For example, if the price was $1 a share, I would want them to pile all of their money possible into buybacks, versus if the price were multiple hundreds of dollars a share, I'd want them to use equity to buy things. Somewhere in the middle is where you get big dividend, and what's an amazing opportunity at $2 might be okay at 10 and not so great at 20. And also, very importantly, things change daily, quarterly. Things keep changing, and so we can't get too much ahead of where we are now. So on the subject of change, what could change for Verde? Well, I believe that one step function type change would be permits. Once they get the environmental permit to expand further, that could be a big change. Perception. We've talked a lot about growth, but the company still trades kind of at a discount to their near-term possible argument for intrinsic value. So if perception changes, both on either the product or the growth of the company, we could have a bit of a re-rating there. Next, scale. Spoke about this a bit before, but if perception, the company, once they reach a certain size, they become recognized and accessible to a bigger group of investors. And so in that sense, scale can matter on more than just for profitability. The other thing is growth. The market works off of what it sees. So if they're growing at 100% growth and that's the target, and year after year 100% growth, then the market will think it will grow at 100%. But if it sees 100 and then 50, it begins to think, okay, declining growth. Is 25 next? So we need to keep watching for the pace of growth and figure out what can actually be achieved. Lastly, information. People treat lack of information, either about products, about companies, about earnings, as a threat, because if we don't know what the future is going to look like, we have to discount for that. But as some of that is relieved, as there's more information and we can kind of get a better picture of what is actually a risk and what the future may look like, people can make better, more informed decisions about the company. And I mean, to see what this means, you just have to look back at the earlier days. There was a lot of skepticism, even from investors, about the product. Does it work? I don't know. Is it better? I don't know. So, there's some people that dig into the science, but even then, there's still the question of, will there ever be enough buyers for the company to make money? And again, I don't know. But as there was the adoption, as people like the product, share, reuse, and think, oh, this is good. This is better than what I was using before. There's increased credibility, trust, and customer base as people go from skeptics to helping spread the story. And I think this works the exact same way with investors. People see the company's executing, maybe they'll buy more, even at higher prices, because more is executed. They'll think, okay, the project gets de-risked. They see there's profitability. They understand what's going to happen next. So, it's information helps people make better decisions. And if the company is a indeed quality investment, having more information would help people realize this. And as far as price goes, I mean, look, we've seen what's kind of happened when too much gets priced into a name. Look at what's happened in some growth names recently. If you're priced to perfection, you need to be perfect. In my opinion, Verde isn't priced to perfection, which makes the risk reward better. But it's still the growth, the eventual success still relies on them executing. If they can execute, I think the price will take care of itself in time. So back to the question that I started with. Is this a growth stock or a value stock? Why not both? And the answer to why not both is because there is only one price, and the price dictates the story. So I believe the company could be worth a lot more if things go well. But for now, that isn't necessarily what's being baked into the market. Whether the stock predicts this in time, but based on, the company proving out the successes, or based on guessing in advance and then being shown to be right, that's out of my control. But what I can say about the stock is it in a way reminds me of Global Atomic back at 50 cents. In terms of back then, it was cheap based on solely on the zinc. So you get the optionality, the free upside from the uranium for free. So in this case, it's only one project, but all the optionality value of what they could achieve, the significant growth potential, is not really reflected in today's price. So today you're more so paying for, what they can do in the next 12 months, the immediate future. You're not having to be forced to pay up for what it could be worth. But the thing is, in both cases, to find out if they will be worth that, you just need to wait and think about, okay, well, what's a discount for maybe them not doing it? Or, what is it worth? How much more could it be worth if they do achieve it? But I think you need to be warned. This investment, just like most, might not fully work out. It might not partially work out. All investments have significant risks, and this is no different. You also need to know that there will be strong seasonality with the results. I think I saw people get very concerned about this last year. Why are sales going down? Well, it's a very regional business and seasonality will be strong. So, don't panic about different times of the year, great results, terrible results, because everything is relative. Also, in bad or slow markets, the liquidity dries up. So there may not be sellers if you need to sell. So, this might not be a good stock for trading because there's very little ability to get in and out. So might not be for everyone. And also, although this is a large position for me because I believe that it will have good odds of being able to achieve the growth that they target someday, it's not somewhere where I'd put money that I were afraid to lose. And on the subject of a re-rating that I kind of hinted at before, if there's no re-rating, which there doesn't need to be, this will be a grind with doubts, with skeptics, with big swings based on, people still having swings in sentiment and thinking, oh, they're going to make it, oh, they're not going to make it, why am I holding this thing, it's going nowhere, there's a bad season coming up, who knows? So there's going to be swings either way. And even if there is a re-rating, the company will still have to prove that the re-rating is deserved. So there is execution that needs to be done. So in conclusion, execution matters a lot going forward with this company and probably will for a long time. However, The reason I really like it is because there is significant potential not priced in. In the short, almost immediate term, who knows? Just the other day, there was a big move in the stock. Probably the market is anticipating something in earnings. If it goes well, it could continue. If it goes poorly, we could see it reverse. I don't know. Very short term. But going forward, I think the primary thing to watch is tonnage growth. If that can continue, the pricing longer term will probably track whatever the market pricing is, and the profitability will track the tonnage growth. So tonnage growth is the main thing I'm watching. The other thing that's important to remember is all of these numbers are kind of roughly as of today. And they will change over time. So if the price is shown to be stickier higher, well then I think you could probably factor that into different things. And as they execute, as they grow, the numbers would change too. Remember, nothing here is investment advice. I am probably biased because remember, this is a larger position. As I've said, I've explained why, but that doesn't mean it will succeed. So with that, I want to wish everyone a great day, and until next time, all the best.